let's move on to the terminologies of purchase of business. When we are talking of the terminologies of purchase of business, the terminologies that are being used in the purchase of business, we ordinarily or literally refers to the specialized language and the terms that are commonly used in the process of buying or acquiring a business. And these terms are important for both buyers and sellers in order to understand and to facilitate smooth negotiation and transactions, and to act naturally in order to acquire the purchase of a business effectively. And all this involve a range of terminologies and terms that are important to understand when navigating all those processes I just said now. Let me now talk about some key terminologies that is related to the purchase of business. The first terminologies is the asset purchase agreement. Of course, this has to be the first terminologies in business acquisition. When we are talking of asset purchase agreement, they also know this as APA, a legal contract that outlines the terms and conditions of the sale of a business asset. It specifies what the assets are included in the sale. It also specifies the purchase price and other relevant details. The second one is the stock purchase agreement. This is acronymically known as SPA. In SPA, a legal agreement that governs the sale of a business stock or ownership shares. And in this type of transaction, the buyer acquires ownership of the entire business entity, including the assets and the liabilities. The third one is the due diligence. When we are talking of due diligence, the process of investigating and evaluating a business before the purchase. This is what this entails, and it often involves a true or duly examination of the business's financial records, the business's contract and the business's operations, also their legal issues, and some kind of other aspects to assess the values and the risk of the business. The fourth terminology is the letter of intent, LOI, or they can also refer letter of intent to as the memorandum of understanding, that is the MOU. Of course, it is a preliminary document that outlines the key terms and key conditions of the proposed purchase, that is the purchase they are looking forward to. All this including the purchase price. It also includes financing details, and it also includes other important terms. And all this serves as a starting point for negotiations. The fifth terminology is the valuation. When we are talking of valuation, the process of determining the fair market value of a business is what valuation entails, and it often involves various methods. The first method is the income-based or asset-based and market-based approaches, and all this can be used to assess the business growth. The sixth terminology is the purchase price. When we are talking of purchase price, the total amount paid in by the buyer to acquire the business is what purchase price entails. And this may include the base price. Of course, base price is crucial. It often includes adjustments and contingent payments. The seventh terminology is the earnout. What do we mean by earnout? Well, earnout is a portion of the purchase price that is contingent on the business achieving certain financial or operational milestones. And all this often is used to bridge valuation gaps between the buyer and the sellers. Just simple as that. The eighth terminology is the closing. What we mean by closing in this instance is the final step in the transaction where all the legal documents are duly signed and stamped, and the ownership of the business is transferred from the seller onto the buyer. The ninth terminology is the seller's disclosure statement. Of course, the seller disclosure statement is a kind of document in which the seller has to disclose the important information about its own business, including its own financial condition. It can also include contracts or any kind of pending legal issue in the business and other material facts All those material facts has to be disclosed in the document. The 10th terminology is the non-disclosure agreement. What we mean by non-disclosure agreement, it is a legal contract that binds parties to keep certain information confidential during the due diligence process and the negotiation to protect the sensitive business information. That's about that. This 11th terminology is the covenant not to compete. When you are talking about the covenant not to compete, an agreement in which the seller agrees not to compete with the business in a specified geographic area, industry for a defined period after the sale is what this only entails. The another point I feel is important to know is the goodwill. When we are talking of goodwill, the intangible value that is being associated with a business, including the reputation, of course, is intangible. The customer relationship is also intangible, and the brand recognition. The goodwill can be a significant component of the purchase price. The 13th one is the escrow. What we mean by escrow is that it is an agreement where a third party in this instance, he will hold the funds, he will hold the document, he also will hold the asset, whichever case may be, on behalf of the buyer and seller until specific conditions or obligations that is between them are duly met, typically at the closing of the agreement. Another terminology is the contingency. What we mean by contingency is that a condition or requirement that must be met or satisfied before the purchase can proceed. Common contingencies include financing, they include due diligence, and it also include regulatory approvals. Another one is the asset allocation. What we mean by asset allocation is the process of assigning the purchase price to specific assets and liabilities of the business for tax and accounting purposes. Another one is the working capital adjustment, WCA. What we mean by WCA is that it is a crucial mechanism that is used in order to ensure the working capital of the business that is being sold is at an agreed upon level and at the time of closing. Adjustment to the purchase price may be made based on the actual working capital scenario. Another one is this stockholder or shareholder agreement. What we mean by stockholder or shareholder agreement is that it is a document, and this document, it outlines the rights, it outlines the responsibility of the owners of the business, including issues that are related to the ownership transfers and governance. Another one is non-compete agreement. In non-compete agreement, a legal contract in which the seller agrees not to start or work for a competing business for a specific period and within a defined geographical area is what this entails. And these are some of the key terms and concepts that is involved in the purchase of business or business acquisition. Although it is very essential for both the buyers and sellers to have a clear understanding of all those terms and to work closely with legal and financial professionals in order to navigate the complexity of the transaction successfully.